Welcome back to the course Introduction to Commercial Banking and Fintech. And in this particular course, we were discussing about the financial accounting. We discussed in the last session about the balance sheet and income statement, and we touched upon how to calculate the net income of a bank, pre-tax net income, and we were solving some of the important concepts and conceptual questions. So this was the question that we tried to solve in the last session. So this is like, how do you calculate, given these details, how do you calculate the net interest income, burden and pre-tax net income? So we solved this and we found that we have 210 crore of pre-tax net income. Suppose government imposes the tax and suppose it charges 25% tax, right? And if you have been given that, can you calculate after tax net income? So suppose at 25%, when we are going to put on 210 pre-tax net income, so we know that it will be 52.5, and after tax you subtract from 210, it is coming out to be 157.5. so this is the impact that we have. Suppose government goes for cutting down the tax rate from 25% to 22%. Now on 22%, so 210 of 2000 of 0.22 into 210, so it is coming out to be 46.2. You subtract 46.2 from 210, so you get 163.8. so you have gain because of this. So 163.8 minus 157.5, so 163.8 minus 157.5, you get the gain of 6.3, and this 6.3 you are getting just because there is a tax decrease, right? So banks will be also, so it is not just the monetary policy that impacts the banks, it is also the fiscal policy. So monetary policy is of course crucial. You also have the role of fiscal policy, and fiscal policy plays very important role in this regard, right? So this is what we get. Then here we have, suppose we are going to have now, how do we see the change in the net interest income from repricing? So for example, we know that monetary policy impacts bank through interest rate channel, because when you have the repo rate rising, the bank's cost of borrowing goes up with the RBI, so they will be charging on the prime lending rate which they lend to the customers. So this is what we have. Then here we have a repo rate high typically raises loan investment yields, right? Net effect of the net III, net interest income, depends on relative repricing and the balance sheet structure. So let's have a look. So balance sheet value is, suppose earning asset is like 12,000 crore, interest bearing liabilities are 10,000 crore. So this is like loans and this is like deposits, right? So this is what we get. Now here we have the, suppose we have the RBI increasing the rate of interest. So repo rate has gone by 50 basis points. So how much it will be, whether it is and suppose bank does in two ways. What it does is that whatever it has seen the increase in rate of interest by 50 basis point, it passes on immediately the 50 basis points to this loan account. And but for deposit also it should give, but normally what happens that bank will be passing the benefit to the customer less. So banks, so 50 basis point is increasing the rate of interest, banks are immediately increasing on the loan accounts. So 50 basis points, suppose you have borrowed money of 5 lakh rupees at 10%, immediately they will be saying that now it is 10.50%. But if you are keeping money at 5%, so ideally it should be 5.5%, but they will be giving you just 5.3%. So 0.2% they are keeping for themselves, right? So this is what is the meaning. So let's think about, so how much is the interest income change? So we know that, so 50 basis points is like 0.005. Here we have a 12,000 crore, so it is coming out how much? rupees 60 we are getting, right. So this is what we have, and here it is in crore. So this we can always say it is in crore, right. So this is what here we have. So 12,000 is the earning asset. So this we are getting. Liability side, on deposit they are just passing on 30, right. So 10,000 of 0.003, it is coming out to be rupees 30, right. So this is what we get. So delta net income impact, how much you are seeing because of this interest change and because of the differential pass on, so pass through you can say, because the monetary policy transmission is not smooth here. 50 basis point RBI has reduced the rate of interest, or sorry, it is increased, but banks are not increasing the deposit rates. They are increasing 100%, or they are passing the all increase in the rate of interest on the loan account, but not on the deposit, and through this they are able to maintain the profit of at least 30 crore, right. So this is what here we have. So net income impact, you can see it is directly linked with the monetary policy. The moment you see, and with this we are able to solve two puzzles. One is that monetary policy transmission is smooth. It is no. Monetary policy transmission is happening, but it is not smooth, right. We are seeing that banks are differentiating, discriminating between asset and liability. So this is also one angle that we often look at. Then here we have another additional policy change. So RBI now increases the CRR. CRR is what? It is called cash reserve ratio. So this is what CRR. Then here we have a second SLR. SLR is what? A statutory liquidity ratio, right. So this is what we get. So on deposit you have 10,000. So now we have 1% increase. So on deposit, so 0.01. So banks will have to keep now 100 crore extra. They will have to keep that as a cash reserve. They will have to keep 100 crore in the form of cash. They cannot use that money to lend, because this is the regulation. So whenever we have a CRR going up, we find that banks will have less cash to lend. They will have all the cash, but they cannot lend this money, because this is by regulation. You cannot lend this money to anyone, because you have to keep that in the form of cash. It is cash reserve ratio. It should be, if something goes wrong with the bank, then this money can be used. Then you have the statutory liquidity ratio. Statutory liquidity ratio is SLR. What does it mean? It means that banks will have to keep, apart from cash, some amount in the form of gold and bullions or any kind of government securities, approved government securities which are approved by the government, that they can be allowed to keep that in SLR. So this is what here we have. Impact or earning assets is this 12,000 minus 100, so 11,900 is this part. This is what here we have. So CRR shock reduces the earning asset base from 12,000 to 11,900, and this is what we get here. So if you are going to think about the asset pricing, so now you can see earlier we had 12,000, but now we have earlier we had the earning asset of 12,000. Now we have the earning asset 100 crore getting down. So now here we have 11,900 only, and this is what here we have. The base has come down, so this will have impact. So it will be 59.5, and liability pricing is going to be the same, right, rupees 30. So now here we have a delta NII 59.5 minus 30, so 29.5. So earlier bank was making 30 crore without CRR change, CRR shock, just the repo rate change. But now we are seeing that because of the repo rate change, it is making 0.5, right. So this is what here we get. So liquidity tools can therefore interact with rate in shaping the bank profitability and others. So this is what we get here. So I hope you are able to understand. Let me give you a quick recap. So what we are trying to say is that if the bank has 12,000 as a loan amount and 10,000 in the deposit, if the central bank is increasing the rate of interest, banks are not passing 50 basis point equally to loan account and deposit account. On loan account, they are passing 100% the increase in interest, they should also increase the deposit interest rate, but they are not increasing. So, this difference is making them earn 30 crore rupees. But what RBI does is that RBI goes for revising the cash reserve ratio. So, cash reserve ratio now it has gone up. So, the money meant for lending, it will come down. So, this is what we are getting, 12,000 minus 100. So, we are having 11,900, but deposit will remain same, because deposit everyone is keeping. So, depositors are keeping. So, you cannot say that CRR has gone up, so will not be giving you money. I have deposited my money. I am the full owner of what I have kept money in the bank. So, bank cannot deny. But RBI regulates the bank by putting extra check by increasing the CRR and SLR. So, this is what we are finding. So, 12,000 minus 100. So, this is what you 11,900. And finally, we are able to see that with this small change, RBI can also control the interest rate spread that the banks are making. So, discriminating behavior of the bank can be checked, and you can see that it has come down by 0.5 crore. So, this is what we often mention, and this is how we call it as the liquidity adjustment facility, right, LAF. Right. So, this is what we get. Now, here we have, suppose we are going to have, so SBI the largest, so we are now going to see the non interest income and expense. So, here we can see that SBI, the largest public sector bank, it earns a lot of non interest income from ATM service charges, remittance charges, account maintenance fees and others, right. Now, you can see in core, suppose SBI has given that increase in fee based income, suppose they are going to see a 40 crore increase, and operating expense they are seeing by minus 15 crore. So, which means that by 15 crore they are seeing a decline in expense, which is a good thing. If you have been told to calculate the improvement in SBI's burden before any policy regulation, if a new fee cap reduces non-interest income by rupees 12 crore, compute the net improvement in the burden. So, this is what here we have. So, if the new fee cap reduces non-interest income by 12 crore, suppose there is regulation coming from government that you cannot charge the low maintenance fee or zero maintenance account fee, then the SBI will not be able to charge. So, because of that it has come down. So, here we have before policy regulations, how do we see? So, here we have the minus 55. So, this is what here we have the delta non-interest expense minus delta non-interest income. So, this is what here we have. So, what comes out that it is around minus 55. So, SBI burden improves by rupees 55 crore. So, this is what we get after fee cap regulation, because RBI wants to reduce. So, here you can see that my income remains same, the expense is coming down. So, it is coming out to be 28. So, if you see the change in burden, how much we are seeing the change in burden? So, burden here we have the minus 15, which is the expense, plus 28 that we are seeing. So, this is what we have. So, how much we are having? It has come down to 43. If you just subtract 55 minus 43, so you have the benefit of 12 crore. So, this is what we are going to see, but here we have the cap regulation, but cap regulation is further reducing the burden of the bank. So, this is what here we have the percentage change. Now, what we are seeing is that because of the regulation change that we are assuming here, that how much we have. So, for example, they are increasing the fee based income. So, they are seeing increase in here, then they are seeing decrease in the non-interest expense. So, how much they are going to see? So, then we can see that at this level we are seeing an increase by 12 crore, and this we have already put here, that if the non-interest income, if it is going to reduce by 12 crore, then how it is going to impact the burden. So, change in burden when we calculate, it is coming out to be close, and it is happening through this process because of this cap that we are going to see, right. So, this is what we are having. Now you can see that the non-interest income and non-interest expense play a very important role, and we can also visualize that how it is impacting the bank, and it basically talks about the efficiency of the banking system. How efficient is the bank? Efficiency of the banking system, right? So burden is basically how basically here we have non-interest expense minus operating income. So if it is negative, it means that it is good for the bank, it is making money, right? Because if it is positive, it means that your expense is higher, so then only it will be, here we can write as burden. So burden is non-interest expense minus non-interest income. So if it is negative, negative is making profit for the bank, and if it is positive, then it means that it is incurring losses. So here in this case we are seeing that it is able to make the profit of 12 crore. Now suppose we are now imposing on two banks, we are now comparing. Suppose SBI as a public sector bank and ICICI Bank, a private sector bank, both have different models. So SBI can give loan to anyone and ICICI also, but ICICI being the private bank, it also has certain freedom which SBI may not have. So SBI, but SBI has the large size, so size gives a lot of freedom for the SBI. So SBI benefits from a stable deposit funding, whereas ICICI relies more on fee based kind of a market link income, because you have wealth management, there are different types of products being offered, so that gives them a lot of benefit. Now we are going to impose two more conditions here. What are those conditions? So one is that we are seeing the monetary policy tightening, so repo hike. Another is the fiscal policy shock. So here we have the fee regulation and GST hike. How can we understand? So suppose we have, I give you the data, I think we calculated earlier also. So this is for the net III, this is for the burden, this you have the provision for loan losses, and this is the tax that we are getting. So we can calculate the net income easily. So calculate the after tax net income from baseline for SBI and ICICI. Assess how a 100 basis point repo hike affect pre-tax net income. So this we can do. Asset side repricing we have to see, and also the liability side repricing we have to see. So interest income and interest expense we have to see. How can we see that if you have fiscal shock coming, fee regulation, GST hike, how it impacts? So here not interest income, and here you have the non-interest expense. So this is what we get. So this is what we are mentioning here. So here we have the baseline calculation. So here you have the net interest income. So interest income minus interest expense. So here we have the 500. So burden is around what we have, the operating expense minus operating income. Right. So this is what we get. If we just calculate, so what is coming out to be? So here we have interest income minus interest expense. So this we can easily calculate. So here we have 330. So this is the burden we are calculating. So sorry, here burden we are calculating. So 330 minus 250, 470 minus 380. So this we calculated here, right? So this is, these two are the burden number. So this is burden, this is burden. Now here we are going for pre-tax net income. So pre-tax net income will be how much? It will be income. So here it will be 1300. So 500 minus provision for losses and also the burden. So this is what we get, provision for losses. So 1300 minus 500 minus provision for losses and also the burden that we calculated. So coming out to be 300. Pre-tax net income is nothing but 500 minus 60 minus 90. So it is coming out to be 350. After tax net income, which is like 30%, and SBI is giving you like tax that we are charging is 30% on both. So 30% we can go by putting what you have, the net income into 1 minus T, right? So this is what we have. So it comes out to be 210 crore, and for ICICI it is coming out to be 245 crore. In the same way, suppose a repo rate increases by 100 basis point and pass through, we are seeing that asset side it is passing 60 basis points increase, but liability cost is high. So bank is more generous, so it is passing, so out of 100 basis point increase, bank is passing 80 basis point as a liability cost and 60 basis point only it is passing on the loan, right. So as a result, you can see it will incur the losses. So balance sheet, you can see earning asset is 12,000, interest bearing liabilities are 10,000 crore, for example. So net interest is how much? It is the 0.006 into 12,000 minus 0.08 into 10,000. So this is the loan, this is the deposit. So 72 minus 80 is nothing but it is minus 8. So this is what we have. So pre-tax income for both banks fall by 8 crore. Let's have the second scenario. In second scenario, so suppose fiscal cap reduces the non-interest income by rupees 20 crore and non-operating expense by 10 crore. So it is going to, because it is fiscal policy, some kind of systematic risk. So you can see that, so plus 10 minus 20 because it is reducing, so 20 it is coming out to be 30. So pre-tax net income for both banks will fall by 30 crore. If you want to see the combined effect of monetary fiscal, so you can see that 8 because of the monetary policy, 100 basis point repo increase, right, and we are seeing 30 because of the non-interest income and expense. So it is leading to 38. So if you subtract from 300, this is what here we have, right, pre-tax net income 300 minus 38, so you get 262, and ICICI will get 312 because it has the higher base 350. So 350 minus 38, so it will have 312 crores. So now we are saying that after tax SBI is having 262 crores and ICICI is having 312 crores, right. So this is what we get. So this is what we are able to understand, and this part is very interesting that in this case as compared to last time, we have out of 50 basis point increase, 50 basis point was increase on the asset side, on liability side was just 30. This situation has been reversed, just to understand the case, right. So I hope it is easier to all of you to understand this case. Now let's have one more scenario which is linked with break even non-interest income under a fiscal setup. Suppose during COVID-19, we know that we have unconventional monetary policy whenever we have, so we are going to talk about, so I think I have highlighted this already. So this is the business cycle that looks like, right. Here we have the peak, here we have the trough, here we have the slowdown, and here we have the recovery. In this we also have something called counter cyclical and pro-cyclical policies, both monetary and fiscal. Counter cyclical in the sense that whenever we have, for example, we had a COVID-19 pandemic, so in that, during that time we saw that government gave a lot of incentive to all the companies and firm. As a result, these companies had a good amount of access to capital, right. This is the purpose. So what is counter cyclical? When economy is in distress, when economy is slowing down, you increase the money supply, you pump more money so that people will try to use that money to convert into more activity, generate more employment, and as a result your economy coming from this side, it goes in this side, recovery side, right. So this is what is the purpose. So during downturns, governments often use credit guarantee schemes to protect banks from loan defaults, and in this case fiscal policy often play important role. In India, emergency credit line guarantee scheme during COVID-19 also reduced banks, they were able to recover losses in a big way, and it also lowered the provision for loan losses, because which they think that they are going to lose money, so they have to keep some money with them. So that what also reduced. Suppose you have been given the scenario that the target pre-tax net income is 120 crore, net interest income is 40 crore, provision for loan losses is this, operating expense is 260 crore. Find the required non-interest income, because in order to calculate the burden, we need to require non-interest income to meet pre-tax net income. Government guarantee reduces expected loss by 40% and recalculate the required operating income or non-interest income to maintain the same target as the net income. So let's do it. So here we have to calculate, because this is the burden formula. So OE minus OI. I know OE, I don't know OI, so I will solve for OI. So I just put the value 120 net income and pre-tax net income. Then here we have a 420, which is the net interest income, minus provision for losses is 70 and minus burden. And so if I solve for this, I get 30 crore as operating income. And now you can see the bank needs 30 crore of not interest income to reach to the target profitability, because bank has a target that it should get at least 120 crore of pre-tax net income, right? So in order to do that, it goes by, so we have to solve how much non-interest income it needs. So this we have done with fiscal guarantee scheme. Suppose fiscal guarantee scheme says that it is 40% reduces the expected losses. Government guarantee reduces expected losses by 40%. 40% in the sense that how much the provision for loan losses the banks are making is 70 crore. 40% of this is already being waived. So what is the loan loss? Now it is just 60%, right? So 1 minus 0.40. So 0.6 into 70. So it is coming out to be 42. So now you can see, if I just substitute here 120, so 420 minus 42 that we got here, minus the burden that we are calculating here. So here 260 minus OI, which is the non-interest income. So you can see that we just need 2 crore rupees. So which means that, so in the baseline computation, we are saying that banks were required at least 30 crore rupees of non-interest income to meet the target of pre-tax net income. But after the credit line, in which the government gave 40%, whatever provision that banks are making as losses, so only 60% they have to take care, so which results in the 42 crore. So 42 crore this, and after that I can see that in order to meet the target, bank have to just earn the non-interest income of 2 crore only. So this is what it means. So what is the meaning? That the fiscal policy acts here as a risk transfer mechanism, and it helps a lot in bringing the governments back on, and they may not be charging so much from customers. Non-interest income in the sense that banks are charging from ATM charges, minimum balance account. So if the government is giving provision, it means that they can walk out and they may not be charging that much, right? And this particular credit provisioning is especially important for micro, small, medium enterprises, and those enterprises are really important, and it also helps a lot in understanding the dimensions of this, right? So with this understanding, I hope you have been able to grasp what we covered. So in this case, we covered 3 important dimensions. Let me summarize that. I think that will help you understand. So in this particular session, we calculated the net income. We worked out with the burden, that what happens when the operating expense and non-interest expense and non-interest income both are having the variations. So how it plays important role. We also put the shock to the system that if the central bank increases the rate of interest, what is the impact of that on the borrowing account and also on the deposit account. If the banks are passing more or equal to the both accounts, then they may not be able to get profit. But if they pass on less, they will be passing more to the loan account and less to the deposit account. Then with that they are able to get more pre-tax income, and this is what happens. And in the case of India, we have done a study and we found that most of the large banks do not follow the culture, and this is very, very important, right? So this is what we often get, right? So this is what we try to find out the case in this. And then we also looked at that what happens when we have the fiscal shocks given. If you are giving more fiscal shock in the form of tax deduction, credit line issue, then we say that even the provision benefits are also helping the banks to cut down on required amount of net income that they are supposed to be, and the tax decrease is also helping the bank to earn more net income. So from those who are from finance background, if you have already understood the balance sheet of the bank, balance sheet of the firms that you have done already in BCom and other courses, and those who are doing from economic side, you may find it interesting that how monetary policy percolates into different financial structure of the banking system through income statement, through balance sheet, and why interest rate change is a key to look out for the banks and other stakeholders. With this, I am stopping it here. Thank you so much, and I appreciate your attention. Thanks.